No,
It's
no,
fine.
let's stay this way.
Okay, that's fine. That's fine. I'll just introduce you and then we can start because
Yeah, thank
you
you.
have just 1 hour. Thank you, everybody, for joining us. Thank you all, especially for those who have made days one and day one and day two of this event. This is Module 7, and Dr. Theo Boufini will be talking to us about tools for wealth protection, retirement planning, generational wealth planning, estate and tax planning. After we have made all the money, how can we preserve? So he's going to be teaching us from different angles this morning. A brief bio of Dr. Theo. He holds a PhD in finance, an MSc in development economics from the University of Port Harcourt, and he has an MBA in BizAdmin from the Enugu State University of Science and Technology. Dr. Theo is a fellow of both the Institute of Chartered Accountants of Nigeria and the Institute of Corporate Administrators of Nigeria. He specializes in financial re-engineering, budget and budgetary control, project management, human resources management. Dr. Theo has over 25 years working experience, and this experience cuts across the print media, banking, upstream oil and gas industry, where he has held various managerial positions. Dr. Theo has attended both local and international courses from prestigious institutions such as the Harvard Business School and the London School of Economics. Ladies and gentlemen, my friends around the call, please help us welcome Dr. Theo with emojis in the chat box. Thank you so much, Dr. Theo. You have 1 hour from now. Do you want me
Thank
to share?
you.
I'm going to make you host so that you can share your slides, right?
Yes, that would be fine. I appreciate
Okay,
that. Thank you. Thank
let
you.
me do that quickly. Okay, I think you're still a participant. I just promoted you to panelist. Can you
Okay.
confirm? Okay, so we make you a co-host, and then you can now share your slides. So I'll stop sharing.
Right, I'm trying to see my options. Okay, sure.
Okay, excellent.
All right, I hope everyone can see my slides.
Yes, we can.
Okay. Okay, let me just increase it a little bit so that we can all see it. All right. Good evening, everyone. Good morning, good afternoon, depending on where you are in the world. And that tells us the almightiness of the God Almighty, that we are different places, different time zones. And of course, the human ingenuity has made it possible for us to all be together, irrespective of the distance. I want to thank Dr. Mrs. K because she's a doctor. What she's doing is far more than what professors would do. So I thank you
That's
so
you.
much. So
Honorary
we
doctorate.
have awarded you a doctoral degree in finance
Thank
today.
you.
All right, because you're doing an excellent job opening our eyes to different things. So thank you. I've never taken the opportunity for granted. It's not as if I am the best. We'll all be learning together as we proceed. All right. I haven't said that today, like I said, we'll be learning together. It's not as if there is one big expert somewhere that will be speaking on things that we do not know. Learning is a continuum, and when you are introduced as a doctor, it gives you more problems because everybody expects that you know it all. When I got my PhD, it only occurred to me that My learning journey has just started. So we'll all be learning together in this process. Please feel free to throw in your questions. That's the only way we can truly learn. 1 hour is not enough for us to understand everything in details. And if we don't throw up questions, we'll be losing a lot. Okay, quickly, this is what we'll be going through in the next about 45 minutes because we would have time for question and answers. The concept, microeconomy, our personal economy, investments, wealth protection strategies, business ethics, and the rest of them. Finally, would have some time for conversations, All right, let me make one bold statement from the beginning. No matter your age, particular circumstances, or level of health, wealth, we all need protection planning, wealth protection planning. So it's not about age. Of course, I recognize that on the call this today, we have diverse age brackets from the very young to the very old, like us. So we'll be speaking to everyone, and we all need wealth protection. We need to plan to protect our wealth. Quickly, there are two prayers. If you look at it, there are two prayers there. So if you were God, which one would you answer? Which one would you answer? It said, deliver us from evil and give us today our daily bread. Which would you be answering if you were God? Unfortunately, we are not God. But looking at it from the finance perspective and wealth protection and planning, what would be your reaction? How would you react to these two prayers? Because of our time, let me just, of course, you are free to give your answers on the chat box. We'll look at them later on. But because of our time, you will see that the cheetah is running after the antelope, and the antelope is running as fast as it could in order to safeguard its life from the immediate danger that the cheetah poses on it. And if you look at it from the perspective of finance and wealth, you would see that on a daily basis, whereas we work hard to accumulate our wealth, there are so many things that are out there that will take away, are threatening to take away our wealth from us. And it is our duty to ensure that we run as fast as possible away from the imminent dangers that would confront us in our journey of life financially. This is a life cycle, individual's financial life cycle, and all of us, no matter your age, would go through in life. From stage one, at very young ages, we start to look at wealth accumulation. All right, we'll start to look at wealth accumulation, and then we'll move on to about 40 to 50, particularly for the men. You now start to look at consolidating. The early stages would be stages of struggle and the rest of them. Later on, when we have accumulated and then we have consolidated, a time would come when we are in our 60s and 70s and up to our 80s, God keeping us well and alive, we start to bother about distribution. Thereafter, we'll now begin to look at how can we preserve our wealth for generations that will come. And we hear of so many people. We hear of the Rockefellers, we hear of the Abiolas, and of course, we will hear of me as well. That we accumulated wealth, we consolidated, and then when we are exiting much later in life, God will give us long life, good health, and then we start to think about how we can preserve this wealth. And these are the things that we'll be talking about very briefly as we go ahead. What is the concept of wealth preservation? What are the concepts, the definition of wealth preservation? I've taken the definition given by Jarvis and Mandel, because it appeals to me the most. And it says that wealth protection planning is a multidisciplinary process of shielding your wealth from all internal and external threats. It is a multidisciplinary process of shielding your wealth from all internal and external threats. So if you break down this definition, there are about 5 things that will stand out. One, that wealth protection planning, it's multidisciplinary. So it means that you can't do it alone. No one can do it alone, irrespective of your professional calling. You need the accountants, you need the lawyers, you need the insurance people, all right, to be able to put you through, to be able to guide us. You need the tax consultants, you need the investment advisors to be able to put us through. And it is a process. It is never ending. It will only end when we die. Even in fact, even when we die, the process continues. So there is no end. It has only a beginning. It has only a beginning. Having said that, it means that at every age, everybody would be involved in planning for the protection of the wealth that has been accumulated. The next is that you need to shield it. You need the protection. How do you protect it from both internal and external threats? How do you avoid taxes, unnecessary fees and taxes coming and eroding into your wealth that you have created? How do you protect your wealth from inflation? These are things that you will need to do. Of course, it is your wealth and it doesn't belong to anybody. You and I would have worked all day, sometimes all night, struggled every day. So it's your wealth that you have accumulated. Finally, we would look at internal and external threats. What are the internal and external threats? Can we identify some? Can we identify some internal and external threats that would pose itself to our wealth planning and protection processes? One of the external threats, like I said earlier, could be a policy. A government policy can come and wipe away everything that we have accumulated. Inflation can also come. These are a few external threats that can come against us. Internal threats could be health, for instance. A major ailments can come our way. Another external threat could be a major pandemic. For instance, in 2020, no one expected that the world would be shut down and businesses suffered. So how do you protect yourself, your wealth against all these threats? That is our focus for today. That's our focus for today. Okay, before we go to the nitty-gritties, what I call, whether it's the macroeconomics, the macroeconomy, or personal economy, which is better? Which of these two events impacts your personal life and personal wealth the most? Which of these two do you think would impact your personal wealth the most? Is it the economy sliding into recession or economy doing well? Or in other words, your personal economy is sudden a very serious medical condition? Which of these do you think would impact your personal wealth the most? Whole lot of persons focus on the macroeconomics. When you go on the TV, the social media, you'll be hearing of inflation, GDP, and all of that. And we believe that that will be the major things that will affect our personal wealth creation and protection. No, our personal economy, things that happen to us, are more important to our personal wealth creation and protection. So, first opinion and advice here is that we must pay attention to our personal economy, the things that happen to us, our persons and our immediate families, because that would impact us most at the most in our wealth creation, in our wealth protection. And what are the reasons why we will need to protect our wealth? Why it is important for us to protect our wealth? First and foremost, it's about economic downturn. Of course, the list is not exhaustive. There are so many other reasons, but for the sake of time, we will not be able to go through all this. But the ones that are most paramount are, for instance, economic downturn, right? Economic downturn can come, and then our businesses are in problem, or inflation can come. If we look at between 2015, 2014, 2015, and today, you would see that the value of our currency has diminished significantly. So that would erode our purchasing power. That will erode our wealth as much as possible. So if you don't have measures that will safeguard that to protect your to wealth, of course, economic downturn would come and wipe off our wealth. There was a time, 2008, 2009, there was a financial crisis in the global financial crisis, and that affected most persons, even in Nigeria and all over the world, where people lost their finances due to the economic crisis that the world experienced. Of course, so you need to be able to look at it. How do you protect yourself? A major global pandemic, which we do not pray for, but it happened in our lifetime in 2020, where most of us couldn't go anywhere. We were shut down. The entire world unimaginably was shut down. So how can we protect ourselves? And then regulatory risks, for instance. Regulatory risk, for instance, came up some years ago from a personal perspective, and I hope Dr. K, you won't mind if I say this. We both held an investment. We both held an investment which is regulated by the Central Bank of Nigeria. So regulated by the Central Bank of Nigeria. And suddenly a pronouncement was made, and that wiped some of us out of business. It took us out of business. So how do you protect yourself from regulatory risk, right? And then, of course, sudden health conditions. We are only human beings. And we are prone to all kinds of ailments and rest of them. Suppose that happens, how do we protect ourselves? Protect our wealth, protect ourselves and our families from untold hardship. All right, so these are some of the reasons why wealth protection is important and why we must take it seriously, irrespective of our ages. Okay, before we talk about protection, before we protect, we have to create. We have to create. And in the last few days from Friday, I know that wealth creation ideas have been created, have been discussed severally every time during these calls. And I'm not going to waste too much time to talk about that, because after this hour, the next person will also talk about the capital markets and how we can take advantage of the capital market. But for briefly, I would only say that for us to create wealth, we must concentrate on building assets. We must concentrate on building assets. Our economy, it's more of consumption. Of course, so if we must create wealth, we must disabuse our minds from consumption to building of assets, irrespective of our ages. Irrespective of our ages, the 5,000, the 10,000 naira, the 20,000 naira that we throw away literally can be used to buy an asset, and over the years, that asset would grow and would give us returns. For us to create wealth, we must also have a very high risk tolerance level. I'm not saying that you should take unnecessary risk, but everything about wealth, it's about risk, and you must be ready to take risk. Lastly, for wealth creation, you have to be obsessed with what you are doing. Whatever you desire to do, it cannot be achieved through wishful thinking. you have to be obsessed. You have to roll off your sleeves to be able to work day and night to achieve the kind of wealth that will transcend generations. All right, so investment, talk a little bit about investments. Of course, like I said, these have been discussed in great details. So we'll just gloss over them without too much details. But for this purpose, I'm sure that we may have been told about risk and returns, but it just as a reminder to us that there'll be risk and there'll be return. And in finance and investment, it is said that the higher the risk, the higher the return, and the lower the risk, the lower the return. Of course, on the left-hand side, you have the two types of risk, the systemic risk and the unsystemic risk. The systemic risk talks about the market risk. The market risk, for instance, if you're buying into the banking stock, the risk that CBN will come up with a policy that will cut across all the banks in Nigeria would be the systemic risk. Whereas the unsystemic risk would be asset specific. Even if you are buying a banking stock, every bank has their own peculiar risk. All right? Every bank has a peculiar risk. So if you're buying that asset of the bank, specific to the bank, that will be the risk. And I've listed out some risks that are there. You have the political risk, the finance risk, the interest rate risk, the country risk. Okay, but let me just take the country risk and regulatory. I've spoken about the regulatory risk. Let me take the country risk, that countries that are seen to be risky, finance would not go there. It says that finance goes to where it is pampered, where it is treated nicely. So if our country, for instance, it's at war, God forbid, no one would want to go into a place like that, irrespective of how profitable our businesses may be. For instance, nobody would want to go to invest in Gaza. So that's what the country risk poses. And that's why currently the insecurity situation in our country poses a big threat to investors. Thank God the political side is stable, so we could get some good investments into the country. I'm sure in the last 2 days or 3 days, as the case may be, we would have been told about capital growth. What would be your focus? What do you focus on? Is it on capital growth or immediate returns? Now, that would be according to your age, according to your risk tolerance. Let me make one statement here. About a week or so ago, I was speaking to some young men on personal finance. And I told them that when we talk about investments, I'm not going to specify to anyone that they recommend investments that to be they could go into. I could only make generic statements because everyone's risk appetite, everyone's focus on investment is different. Some may want capital growth, others may want immediate return. Depending on your age, a 60-year-old person would now be looking for capital growth that much. Will be looking for immediate returns. Will be interested in dividend-paying investments that are secure, investments that can guarantee returns. Whereas the 20-year-old boy would be looking at capital growth because he still has enough time. All right. As I said, we've talked about a lot about investments in the last few days, so I'm not going to treat too much of that. But one aspect that I want to bring to bear is the fact of inflation, the effect of inflation on our investments. Okay? So inflation risk refers to possible loss of future purchasing power arising from our investments. And most times, investors may not take the inflationary risk into consideration. when they are looking at investments. For instance, some years ago, um, the rate of inflation had risen, even though from calculations that they have changed in methodology, it said that the inflation has reduced. But that may not be true. So if you are if you are going into any investment, you must look at how the impacts of inflation on your investment. And there are two rates. One is the nominal rate, which does not consider inflation. And then the other is the real risk, which is what you should be interested in. The real rate of return is the one that has inflationary rate has been taken into consideration. All right? And as a generic statement, the impact of inflation and investment, for instance, on fixed income, is most impacted. The reason is that fixed income, what I mean by fixed income, things like treasury bills, it's tenured, and of course, there is a fixed income. So if you are buying a treasury bill, for instance, let's say for 180 days or 90 days, 180 days, 364 days, there is a fixed rate. It could be 20%, could be 18%. So that rate will not change over that period of time. And if there is an inflationary increase, a rate of inflation increases, you cannot do anything. You can't do anything. So you need to look at it, how inflation impacts on your investment. The next is the capital market. Because the capital market doesn't have a fixed rate of return, it is less impacted by inflation. However, it is quite volatile. You could lose your money. Some years ago, as a young person, I just left banking and I moved into another industry. After 6 months of work, I was paid my some allowances, and I used that allowance to buy a stock. I think it was in 2005, 2006, thereabouts. I've used the I used the allowance to buy a piece of land, a plot of land somewhere in Port Harcourt. After a few years, the land appreciated, and then the capital market rush came. I sold that plot of land. I didn't stop there. I also went to borrow money from the bank, and I bought stock with the mindset that I would sell the stock and make profit, only for a few more months to come, and the stock prices dived. I lost both my land, I lost my money, and I had the bank loan to repay. A whole lot of persons also lost money during that era. Okay? Some persons never recovered from it, but because I was younger and I was still working, I had to repay the loan that I took with my salary on a monthly basis. Then the real estate market, which is the lowest impacted, it has the lowest impact by inflation, because when you buy a plot of land or a property, inflation is usually adjusted. The price, it's always considered with inflation in mind. So these are some basic little guidelines that we can give. All right, let's talk about just briefly, about investment instruments. I know that has been done, so just a reminder in case we forget. We'll talk about the capital market, the money market, foreign exchange market, and then gloss through the real estate market. Of course, the primary market, the capital market is broken down. For the sake of our younger people, the capital market is primarily for two types of securities. You have the equity securities and the debt securities. By equity securities, we mean stock, shares, bonds, and then the debt securities, of course, we talk about bonds, okay? For either the federal government bonds or the corporate bonds, what we call the commercial papers, okay? And then the primary market is broken into the primary market, the secondary market, and the private equity. The primary market is where companies that are quoted on the stock exchange come up with their initial public offer. When they give their initial offers, they start to sell their initial shares to the general public. That's what it means by primary market. Then you have the secondary market, where after the initial public offer to the public by the companies, and then they are listed, of course, after their location. These shares belong to individuals, and the individuals can sell those shares without any recourse to the company. They can trade with it, and either sell or buy depending on your financial requirements. These markets, as I said earlier, you have the ordinary shares, the preference shares, and the bonds. And by way of rewards for your investment, you get dividends, you get capital appreciation, and of course, you get the bonus shares as a way of compensating for the investment that people have taken. As we may have been told, the capital market is regulated by the Securities and Exchange Commission. Of course, it's highly, highly volatile. Prices are not stable. Today it could be up, and tomorrow it could be down, depending on the markets, depending on the information and perception of the players in the markets. We have the private equity that is for companies that are not listed on the stock exchange. They can also go to private individuals and raise money. They can ask you and I to buy their shares. In doing this, we must be very, very careful. Whichever one you want to play, either in the capital markets that is regulated or in the private equity, we must seek advice. We must look for those that have the knowledge to advise us adequately so that we do not lose our money. Okay? But whatever it is a good place for us to invest in. Shares that I bought some 20 years ago, 5,000, 10,000, today, if I want to sell them, they become something reasonable. And I can realize them. I can sell them quite easily if I want to raise money. Then we have the money market, where short-term financial instruments are traded, okay? Because the capital markets, the tenor, there's no tenor. It can be, as I said earlier on, I bought some shares 20, 25 years ago as a young person. Those shares are still there unless I want to sell them. But for the money market, there is a tenor. Could be 90 days, could be 30 days, it could be 60 days, it could be 180 days, 364 days, whenever. But there is a tenor. A tenor, what I mean by tenor, there is a duration. There is a duration. And some of the instruments that are traded there, you have the treasury bills. And I think every 2 weeks, the federal government of Nigeria offers treasury bills. And the advantage of the treasury bill is that it is tax exempted. There's no tax. Okay? Let me go back to the capital market. The dividends that you receive, are subjected to withholding tax, right? So if there is a 1,000 naira dividend that is paid, what will be paid eventually to the beneficiary, to the owner of the stock, would be less the withholding tax rate. And I think currently withholding tax is about 10%. Okay, so we need to take this into recognize this, that treasury bills are not subjected to withholding tax. Commercial papers are for corporate entities, and they are subjected to withholding tax. But the same with bankers' acceptances. All right, bankers' acceptances are just almost like the treasury bills, commercial papers issued by corporate entities. The only difference would be that there is a guarantee by a bank that in case of default, the bank would pay the money. So that's what it means by bankers' acceptances. The certificate of deposit are just fixed deposits, and then the savings account, which we are all aware of. Except the treasury bill, all other instruments are subjected to withholding tax. So even the savings interest that we get, if you do not make withdrawals, most banks will tell you that if you do not make withdrawals in your savings account for more than 3 times in a month, then you'll be given interest. All right. And that's difficult anyway. Most times we go to make withdrawals in our savings accounts more than 3 times a day. I mean, 3 times a month. So it depends on what you require. What are your financial needs? What are your objectives for investing in this? What are your liquidity needs? And of course, when you approach the experts who would guide you, all of this will be discussed on the table. Of course, we have also stated some advantages and disadvantages of all of these instruments that are valuable on the market. Well, we'll talk about the foreign exchange markets, where the foreign exchange currencies of foreign countries are traded. All right. But of course, this would be done at the official markets. We do not encourage people to go to the black market to buy. So for you to be able to do that, you have to be licensed, either through a bank or through the Bureau de Change. Okay. And these are some of the different options that are available, different types that are available that you can go into. Let's briefly talk about rules of investment. All right. One is that you must research your options. And that's why calls like this are important. All right. So that you understand the markets, understand the dynamics of it. You will also be able to evaluate your risk by speaking to the experts. We must avoid hasty decisions. Okay, we must avoid hasty decisions. We must think long term. We must analyze the market trend. We may not have the competence to do that, so we must have people around us that have the competence to analyze the market for us and advise us appropriately. We must plan long term, set financial goals. Okay, we must buy stable assets that are stable, but there would be fluctuations temporarily. We should also ignore those temporal fluctuations. Okay. Remember compounding, because the money you save today would, of course, will continue to increase. So you must also remember compounding. To avoid we must avoid markets, trends, and fads. There's so much noise. Like I told you earlier on, around the 2005, 2006, there was so much noise about the capital market. In fact, everybody became a broker. You see every young man, every young woman that suddenly become a broker. There was so much noise. And that led people to deceive people and led them to invest in dead assets. Okay? So we must avoid speculation. We must not listen to the noise. We must avoid speculation. We must prefer long-term gains against short-term gains. All right? Of course, I'm sure that we've been told about diversification. You don't put all your eggs in one basket, as we would always say. So diversify your assets. Don't put all your assets in one industry or in one asset type. So that if one asset is not doing well or one industry is not doing well, the other would do well and compensate for the losses or losses, as the case may be, that you will get from the ones that are not doing well. Regularly review. You have to review, check your performance report. Of course, you need to check, and then rebalance your portfolio. If one asset is not doing well, if you are too concentrated in one particular asset type or industry, you need to redistribute, right? You need to redistribute. The place of consulting financial experts cannot be overemphasized. Okay, even if it doesn't come free, It is better that you pay that little fee than losing your entire wealth. So always look out for financial experts and speak to them. Speak to them. Okay, let's come a bit closer to our focus for today, wealth protection. One, business entities. All right, I will just speak briefly on that. We know about setting up organizations, corporations, like limited liability companies or partnership, so that you can transfer your assets into that area. So for you to make wealth and protect it, you need a business entity. You need to register a company to be able to do that. The next, we're talking about estate planning, insurance, and retirement planning. Okay, so what is estate planning? Okay, of course, all of us, whether we like it or not, no matter how for us in Nigeria, you say it's over, it's not my portion. As we are all born one day, someday, we would all exit. We would all exit. And every now and then, we hear of cases where people do not plan for their exit. And of course, our culture also encourages this because we do not believe in it's not our tradition. Originally, our culture, if for instance, in my place, when somebody dies, you don't need to write a will, for instance. The tradition is in place that everything that the person owns will be brought out, and the children would declare it to say, "My father, my mother had this," and then it will be distributed amongst all of the brethren. Now, another challenge we have is that nobody wants to talk about this because we think that death it's not coming, but it will come. So, in order for us to prepare ourselves and protect the generations after us, we need to write a will. You need to write a will. And what is a will? It's a legal document explaining how our assets will be distributed on the passage of a testator. The testator is a person who has written the will. I've seen educated persons. I have seen judges, a family member who passed on, who was a high court judge, of course, did not write a will, which is bad enough. So we need to write a will so that the things that you have acquired can be distributed. You know, you determine how these things will be distributed. Okay? And then the process. So you determine your assets. What are the assets that you have? Decide on the distribution. How do you want to distribute it? To who? Okay, could be to charity, could be to individuals, your children, and anybody that you require. And then you must write it. You don't stop at just writing. You need to perfect it as well. You need to perfect it. In doing this, of course, you need a lawyer to guide you. You need a lawyer to take it to the court to be able to perfect that. A will would give you the opportunity to determine how your assets would be distributed. Of course, you are the owner of the assets. A will is also has a flexibility to manage your estate. So it has the flexibility to manage your estate. Remember that once you write a will, it is not final. And that's why you can keep changing it until the final will. That's why they said the final will and testament. So until the person dies, you are at liberty to change your will at any point in time. Okay? If you don't have a will, of course, then the beneficiaries or the children, the family, will now have to approach a court to go through a lengthy legal process, and then the court will appoint administrators of the estate. And once you don't have a will, it says that the person died in estates. Okay? Let me also give another proviso at this point in time. Please don't ask me legal questions. I am not a lawyer. I may not be able to answer. Anyway, you can ask. Maybe there'll be lawyers on the call here. All right? The will may, and mark my word, may, and it's in red deliberately, reduce conflict um, amongst beneficiaries, may reduce it because it doesn't completely say that there will be no conflicts. We've seen cases where the wills have been contested by 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 the beneficiaries. People would feel aggrieved that they ought to get a little more. All right. Some disadvantages may be that when you write a will, the process of perfecting it when the person dies, you need to go to the probate to be able to do that. And of course, the probate is not free. It means that there'll be about between 5 to 10% fee that the courts will charge. That's 5-10% of the total asset, total value of the assets. That is to taking away part of the monies that would have been available to the beneficiaries. It does not protect for taxation, and of course, it doesn't reduce disputes completely. We've been cases where for years and years, wills have been disputed. There have been arguments back and forth, So for 10, 15, 20 years, those assets will just be lying fallow. But it's better that we write something than not writing anything at all. Next, it's which is better than the will, is a trust. The trust, that you establish a trust. Trusts are legal entities that allow one or more persons, the trustees, to manage assets on behalf of others. So, for instance, Mr. A creates a trust to manage the assets of its on his demise, or even when he's living. You can create a trust to manage your assets while either during your lifetime or after the lifetime of the person. So the trustees would be the ones would manage the assets. These assets are transferred to the trustees, to the trust fund, and they manage it. In fact, if you're alive, you can also still ask them. They can be paying you, all right, from the trust. So the trustees will manage them. And there are a lot of companies that are involved in trusteeship in Nigeria or elsewhere. All right. And these are the parties to the trust. You have the grantor, the owner, or the person who has created the trust. The beneficiaries, those that will benefit. Of course, the grantor can also benefit if the person is alive. And then you have the trustees. You have two main types of trust, the revocable trust and the irrevocable trust. As the names imply, the revocable trust is one that you can change it at your lifetime, okay? But it has to be by the grantor, by the person who has created the trust and nobody else. The irrevocable trust cannot be altered. It can't be altered, okay? No matter what, it cannot alter it. Some advantages and disadvantages of establishing the trust is that it gives further protection to your assets. It gives further protection to your assets. And of course, it takes away unnecessary disputes that may arise from writing a will or not writing a will. You have total control. The grantor has total control of what happens as a result of establishing that trust. It is private, and of course, you avoid the taxes. You reduce the tax burden as much as possible. Okay? Part of the things that the taxes would take, if you create the will and assets are transferred to the children or to the beneficiary, there is a capital gains tax, and it's not cheap. Okay, it's not cheap. On the downside, there is a cost of establishing the trust and running the trust because nobody will do it for free. So there is a cost, and there are some complexities in establishing it. So these are things that the legal group or the accountants would advise on how it should be established. Okay, so the next is some form of insurance. Of course, we know what insurance is. So you can insure your assets from losses, fire. For us that drive vehicles, you are employed legally to insure your vehicles. Otherwise, it becomes a crime. And recently, I also learned that the Lagos State government in Nigeria, has come up with building insurance that landlords are mandated now to insure their buildings compulsorily against fire, against collapse of buildings, so that the tenants can have some protection. Okay, so we can also have life assurance policies to ensure our lives, just in case something sudden happens, so that our children, our beneficiaries can get some relief, some support, as a result of that. Or they may not even be dead. It could be disability, and we lose our limbs, or something happens that we may not be able to work. So this would happen. So insurance, it's another way of protecting ourselves and our assets. And remember, we are the greatest assets that we have. The next option, it's the annuity. The annuity, it's what you invest in. It's a sort of pension scheme, for instance, to guarantee that you have some continued income when you retire. And annuity became very important for those that at a point where companies didn't have the pension scheme. All right, so some persons came up with this initiative to have annuity. And I tell you, it's a good initiative, particularly for our young people. When I was preparing for this, and then the other program that I did, it occurred to me on the need to have an annuity. And I consulted an insurance expert because it's provided by insurance. And I said, okay, I want the deferred insurance because you have immediate insurance, I mean, an immediate annuity and deferred annuity. I said I wanted the deferred annuity, which means that in the next 10, 15, 12 years, or let's say 7 years from now, that's when I start to draw. And they asked me how much was it that I would have loved to have on a monthly basis. And I mentioned it. When they gave me the quote, it was over 200 million naira. And but at this point, it didn't make sense because if I have 200 million naira to put there, and I put it in the money market, it would have given me perhaps the interest that I would get, the yield that I would get will be far more than the annuity. However, even the insurance expert at that point opened up to me and said, do you know that I work in the insurance industry? The annuity didn't occur to me. The advantage would have been if we had started 10, 15, 20 years ago, these 200 million, perhaps I would have been dropping small, little money. And at the point that 7 years down the road, I probably would have been getting the interest, the return that I wanted. But because I didn't do that, I have to pay a little more. So the advice for our young people is to look at this and have a target. 20 years from now, I want to do this. What would it cost me? And in the event that we do not even live up to the 20 years, God will grant us the grace, protect us, protect our health, and we'll live up to them. But in case the other one happens and we don't get to live up to the age that we thought we'll live, our beneficiaries will be paid that amount. But once we live up to that age, we start to draw from that annuity that we have created. So it's an additional wealth creation or protection method that we are guaranteed some minimum income even at old age. A friend of mine was speaking to me. He said, our generation is the unluckiest generation. And he gave the reason was that we take care of our parents, okay? And we still take care of our children. Before our
Dr. Theo,
parents would, yes, please.
Just process check. I don't know how many more slides you still have.
No, I'll
but
soon be rounding up.
your audience will certainly, I can see there are lots of questions for you, and your one now is almost 4 minutes.
Yeah, I will soon be setting up. I'll soon be I'll soon be rounding up rather.
All right, sir.
All right, so annuity, it's one option that we have. to look at. Insurance and annuity is one option that we can look at. Finally, before I leave annuity and insurance, please let's remember the fine print. What we call the fine print is those small letters that are written in the insurance. And if we do not read them or we do not consult the experts on them, we will run into trouble, because at the end of the day, when it is time to pay the premium or the return to come to us, the insurance companies will always refer us to the fine print. Apologies if there's anybody who is in the insurance industry here. Okay, so let's go to retirement. Quickly, I'll talk about retirement in a few minutes. When this topic was sent to me, the first thing that came to my mind was, or that I saw, that the first point that I saw was retirement planning. And I said, oh, how can you talk about retirement? You are not retired. How can you talk about retirement? And it occurred to me that, do you know that you've been retired unofficially about over 10 years ago? An event happened and I was thrown into exile in my place of work. Before that event happened, I'd given all my life, everything to the job without realizing that I would leave the job one day. So just as the case of birth, retirement would also come someday. And most unfortunately, most people are not prepared for it. All right? So the best time to prepare for your retirement, if you have not started, is today. And the best time that for those that are younger, the best time to prepare for retirement is the day you started your job. So you prepare for it. Otherwise, retirement becomes painful. And we see people clustered and littered everywhere that they are retired and they are depending on friends and the rest of them. Of course, I also recognize the fact that the economic situation may not be too good. So retirement, one, is a gift. It's a gift of time and opportunities. So we have to redirect our lives purposefully. How do we utilize that gift, that extra time that we have? Number two, our belief window. How do we perceive the belief window is how do we perceive the world? What are our assumptions? What are our beliefs and values? Retirement does not mean that our lives have come to an end. No, it is just an opportunity for us to do something else. Footballers they retire from football at 25, 30, 35. They are not old men and they are not wasted. So what is your view? It is our me time. It's time that you have to do things for yourself, do other things, okay? And the major stress that we would have is the stress of doing nothing. If we don't have anything to do, it's a stress. So the one thing that we must do in our retirement plan is, what do we do after we retire? What do we do after we retire? And I was confronted with that when I came to that reality over 10 years ago. Oh, what would, if I had retired, what would I do? And that redirected my attention, my focus, and my plan to do other things along the job that I have. As young men will call it, I now had a side hustle that I can fall on when I eventually retire very soon. You must also have a purpose. Somebody said, I have retired, unretired, and retired again, all in the past 10 years. I find the biggest trouble with nothing to do. Okay, so you must have a purpose. What do you do? And it's a purpose that will give you the impetus and the strength to get out of bed in the morning, because you have time. Nobody chasing you to go to the office by 8 o'clock. Nobody will query you, but you must have the purpose. Okay, you also must plan for your retirement. Okay, retirement, like I said, is as sure as the day and the night. It will come. If God gives us the good health and long life, it will come. And for Nigeria, it is 60 years of age or 35 years of service, whichever that comes from. Some other clients in Europe and America, some could be 65, 70. But no matter how long it will, it will come. So you must plan your finances, you must plan for your health, you must even plan for food, you must plan for where you will live, okay, after you retire, your home and rest of that. You must have those discussions. That is part of the planning of retirement. All right, so without too much taking to, so that I do not exceed the time that is allocated, I will stop to speak from now. I can then take questions. Thank you so much.
Thank you
Over
so
to you.
much. Thank you so much, Dr. Theo. Thank you so much. We appreciate the presentation. Can you please stop sharing?
All right, yeah, stop.
Yeah,
Yeah,
it's so
thank you.
exciting. You were able to touch on different aspects of the conversation. Well, I'm just going to let you take a cup of water, and then I think because of the way the time is, we will take the next presentation, and then we do the question and answer together at the end. So we have our sponsors already in the house. I'm going to give Mr. Hafiz Ogumbi co-host rights so that he can do a quick presentation telling us about opportunities that the organization have for friends around the call. Are you spotlighted? Let me see. Timothy, did you spotlight Dr. Theo?
I'm did that now.
Okay. No, you were not supposed to spotlight him. We have Mr. Ogumbi to speak to us. Now, I've made you co-host, Hafiz. Good to see you.
Yeah, pleasure. Great seeing you too, man. Good afternoon.
And good to see a face to the name, right?
Yes, I
Okay, so you
understand.
have co-host rights now. Can you please go on with your presentation?
All right, thank you so much, ma'am. And thank you, Dr. Theo, for that wonderful presentation. I think even I myself have picked a lot of things from the presentation. Good afternoon, everyone. I trust we'll all have we've been having a great day. My name is Hafiz Ogumbi. I work with Cardinal Stone. Cardinal Stone is a financial service firm. We do things around investments. We have various verticals in the ecosystem, ranging from securities trading when it comes to you buying shares, selling your shares, trading basically on the floor. We have the asset management business that does, if you're looking at mutual fund products, fixed income investments, things like treasury bills, like Dr. Teo had mentioned earlier, and a host of other investment opportunities. We have the investment banking space where we help our corporate clients raise funds. I mean, you would see that since last year, you've been seeing the likes of Access, Zenith, and a number of other banks coming to the markets to raise capital. And that's part of the things that we do. We help them raise the funds they are looking for to buffer the capital base. So we also help with mergers and acquisition. We also have entities that do financing. If you're looking at loans and the likes, we do a host of that. But Virtual today, I will just be talking to us briefly on investment opportunities.
IG,
Hafiz, are
Solomon,
you planning to share your screen or not? No?
Yeah, yes, I'm doing that just
they
now.
died.
Um, sorry, just in a minute it will come up. Just trying to. Sorry, I'm struggling to. Okay.
You can also
Sorry.
speak on, unless you want to send it to
Okay.
me to share for you. Anyone? Is it something you can pop in WhatsApp quickly? Otherwise, just please speak on.
Okay, I think it's here now.
Okay.
Okay. So can you confirm you can see my screen?
Yes, we can.
Yes. So briefly, I will just be talking about investment opportunities, some of the investment opportunities you can have with Cardinal Stone. We Dr. Tio had mentioned earlier that you could in the capital markets you can either do maybe equities or you do bond, the equity market, and then there's the debt market. The debt market, basically, you have the likes of treasury bills, commercial papers, and the likes. For the peculiar thing about equities as well, the peculiar thing about investing directly in some cases is that for, say, treasury bills, for instance, the minimum investment amount is, for instance, to go directly to the primary market for treasury bills is like 50 million naira, 50 million, 1,000 naira. Although you see some firms also break it down to say 5 million or 1 million and the likes. And then you may not really, not everyone will have that capacity to invest directly in all these instruments. So that's where mutual funds come in. So mutual funds just come with the idea that, okay, we are pulling our resources together. I have 5,000 naira, I have 10,000 naira, you have 100,000 naira, and then you are giving it to an asset manager who then invest. So with that, we all pull our resources together and then we invest it in in a particular instrument or in a diverse range of instruments. So we have the money market instrument, for instance. When you talk about money market fund, you're talking about things like commercial paper, you're talking about treasury bills, you are talking about fixed deposit and the likes, those short-term instrument below 1 year. So for someone like me, if I want to have exposure to commercial paper and treasury bills, and I do not have maybe a lot of money to go around for all of these, I can have access to investing in all those kind of assets by investing in an instrument like in a fund like money market fund. So it's a regulated fund, regulated by SEC, and you are certain that your principal is guaranteed. It's a very low risk investment. And with a minimum of 100,000 naira, you stand to benefit from what people that are also investing in 50 million, who also have 50 million to invest directly in treasury bills are benefiting. So that just helps you, grant you access to the investment opportunities. You have things like the equity fund. So for someone like me now, for instance, or for someone like, we have people who you may have, all you have is maybe 10,000 naira to invest. You may not have the knowledge. You may not have the knowledge to, okay, which stock should I buy if I want to invest in stocks? Do I buy Access Bank? You may not have the information on the stocks to buy. However, with the equity fund, you are giving it to expert because we are managing, we have knowledge of the markets. We understand how all of this happens. We have the time, we have the information at our fingertips. With that, all you are just doing is investing, say, 100,000 naira in the equity fund. To say, okay, I'm investing 100,000 in the equity fund. And then we, as the asset manager, as the fund manager, we are making those investment decisions on your behalf on what shares to buy and what to sell. At what point should we exit the stock? At what point should we come into it? So instead of you looking at, okay, I want to buy XYZ stock, I want to buy ABC share, you necessarily do not have to bother about the headache or have to check your mobile app to say, okay, what can I buy now? What can I sell now? You just invest in the fund, and the fund is actively managed by experts. So with that in mind, you just know that, okay, all I have to do is whenever I need to invest in stocks is to fund the equity fund, and you by default you already have exposure to a number of stocks that a number of stocks already, and with that you can you're also an investor on your own part. So like that, you can always structure things. And the balanced fund also is it's just like the name is balanced. We're looking to balance between equities and debt instruments. So in the balanced fund, you may have 50% of your funds in equities, 50% in fixed income instruments like treasury bills and commercial paper and the likes. So instead of you are thinking, oh, I want to have a portfolio of my own, but you don't know how to structure it. You can easily invest in a balanced fund to say, okay, I do not want 100% exposure to equity because it is a volatile space. Like Dr. Theo mentioned also, he shared his experience on how he lost money quite a number of years ago while he was still starting off. You would see that. But now, instead of investing directly in stocks, or you don't want to have 100% exposure to equities, you can invest in balanced funds. In balanced fund, you have exposure to equities. However, there's still a portion of your investment that are in low risk assets like treasury bills, commercial papers. And for these funds, the minimum amount is really low. You can say for balanced fund and money market fund, it's just 100,000 naira each. For the equity fund, fixed income alpha fund, 30,000 naira. The fixed income alpha fund is also just like the name, it invests in fixed income instruments. How it is different from money market fund. They are both low risk instruments. However, how it is different is that money market fund will invest in shorter tenured instruments, T-bills and the likes. But for fixed income alpha fund, it invests in long term. So if your plan is say, oh, what I'm saving towards or what I'm investing for is a long-term investment, and you want to really escape the volatility in the short term of money market fund because it is subject to changes in rates, you can do alpha fund since it invests in longer tenured instruments. So that stability will be there over a longer period. There's also the dollar fund that can help you hedge against currency devaluation. So you would see that if you hold 10,000, everyone knows that 10,000 naira 10 years ago is not the same as the 10,000 naira that we have now. So you may have a portion of your money that you also want to keep in a stable currency like the USD, and that's where the dollar fund comes in. Low risk investment that invest largely in FGN Euro bonds and some corporate Euro bonds as well. With a minimum of $500, you can hedge a part of your portfolio towards currency devaluation and FX volatility. So for this investment, each and every one of us will have what suits us. For people who are conservative investors who feel like, oh no, I can't play in the equity space. I do not want anything happening to my principal. You can consider investing in things like money market fund or fixed income alpha fund because they give you 100% guarantee that your principal is preserved. If you are willing to take maybe a little higher risk, you can invest in equity fund because with equity fund you can get your capital can appreciate faster because stocks tend to appreciate faster, return higher. However, there's still the likelihood that you can lose in the short term. Your principal can be exposed to the risks that are inherent in investing in stocks. So if you're just looking for a mix of both, you can look to invest in a balanced fund with a minimum of 100,000 naira. And also, if you are looking at maybe, oh, I don't want to do any of the mutual funds, we also offer other investment fixed income instruments as well across Naira and USD. If you're looking at 90-day, 180-day, 35 days, we can either help you invest in treasury bills or we have a Naira fixed income investments where we give you a fixed rate for depending on the amount that you're bringing in. So for fixed income investment, minimum is 5 million naira. We also have investments across 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 different tenors as well. For USD, there's the GBP money market investment, 5,000 pounds minimum. There's the USD money market investment as well, $5,000 minimum, and there's the 2-year Eurobond investment notes that has a fixed rate as well at $20,000 minimum investment. So there are a host of other investments that will help, especially if it comes to maybe you have a peculiar need. We always try to tailor things to suit the needs of our clients. So at this point, I wouldn't want to take too much of our time. Maybe if you have any questions, I could take them at this point. Thank you so much, everyone.
Thank you so much, Afiz, and thank you to you, your team, and Cardinal Stone for supporting us. We know that
pleasure.
All the resources you have for us, you can give to us in this sitting. We're going to take questions at the end of Dr. Charity's presentation. We're going into the next module, so we'll take all the questions together for you, for Dr. Theo, and for Dr. Charity, so that people people can decide when they want to maybe leave the program. But I would stay to the end,